Good afternoon, everyone. I'd like to welcome everyone onto this webinar, preparing for the 25% corporation tax rate this afternoon. It's great to see so many attending. If anyone has any technical issues, please feel free to contact us using the chat function. And we'll be having a Q&A session at the end of the event, so please feel free to post your questions in the Q&A box as we go through. And we'll pick these up and address these later. Also on the panel this afternoon, we've got Gerry Jack, who's a chartered tax advisor here at Oldfield. It was just over a year ago, on the 3rd of March 2021, that Chancellor Rishi Sunak announced in his 2021 spring statement that the rate of corporation tax will be increasing from 19% up to 25% from April 2023. And that's for any companies with profits over £250,000. Now, just to provide some context around that decision, at the time, the deficit was at record levels, and the government was looking at ways to balance out the £407 billion worth of support that they provided throughout the COVID crisis. Now, I think it's always interesting when looking at tax rates and changes to just step back and compare how our corporation tax rate compares with other countries around the world. Now, for reference, you'll see on this chart on the screen, this is the top 10 countries by GDP and their current corporation tax rate. Now, I just found this data very enlightening, just to note that many similar sized economies to the UK already have a tax rate of 25% or even higher. So the UK, the 19% is a very low tax rate in comparison. So just turning to today's event and the agenda, what we'll cover. Firstly, we just want to go over just in detail, the increase and how it'll actually work for companies. Then we want to address the question of incorporation. Is it still worth it with these changing tax rates? We want to look at a few ideas we've had in terms of directors' income and profit extraction and how to really maximize this. And then we've got a few points we need to cover off on what we should be looking at now and what we should be deferring until after the changes happened. And then we'll have some key takeaways and we'll finish with the Q&A session. And really throughout this webinar, I just want to really stress that whilst we need to be aware of the impacts of this tax rise, the key thing is to consider how we can use this for maximum advantage for us, for our tax saving. So looking at the opportunities rather than the cost. So looking at the increase and how it will actually work for companies, it very much depends on your level of profits. And the simplest way to look at this is just to look at 3 examples. So firstly, we've got a company that's making taxable profits of £50,000. For this company, there will be no change to their corporation tax rates because any companies with profits up to £50,000 will remain at the 19% tax rate. So for them, there'll be no change. Our second example, however, has got taxable profits of £500,000. So again, this is relatively straightforward. They will just pay the increased rate at 25% because the 25% applies to any company with taxable profits of above £250,000. So what happens if your profits are somewhere between £50,000 and £250,000? That's where our final example comes in. So they've got taxable profits of £120,000. Now, the way it actually works is that they'll pay 19% on the first £50,000 of their profits, and then they'll pay 26.5% on the profits above that, up to that £250,000. Now, the reason behind this is that this then tapers the overall effective rate, so that at £250,000, you're paying the full 25%. So in this example, they'll pay 19% on the first £50,000, and then they'll pay 26.5% on £70,000 to get them up to the 120. So that gives them an effective corporation tax rate of 23.38%. Now, the first suggestion that often comes to mind when you're looking at this is, could I split down my trade into numerous limited companies to make sure I only pay 19% corporation tax instead of the 25%? Well, unfortunately, but rather expectedly, there is anti-avoidance legislation in place to prevent this for associated companies. There may, however, be some benefits for some companies that have cross charges from a holding company in certain circumstances. Now, for the remainder of this presentation, and for simplicity, we'll be assuming that the examples and the companies we're talking about have profits in excess of the £250,000, so they're paying the 25%. Now, the other very important aspect to consider when looking at how this will impact our businesses is in relation to the timing of the change. And it's not as straightforward as it initially seems. So the increase rate is taking effect from 1st of April 2023. So unless your company has a 31st of March year end, you'll have a transitional year in which some of your profits are taxed at 19% and some are at 25%. So you can see this timeline here. Here we are now, we'll be paying 19% corporation tax up until your next year end. From then onwards, you'll pay what we call an effective transitional rate. Now, as an example, most of our clients, or majority of our clients, would run their accounts to December year end. So the impact for them is that the year to December 2022, the current year, they'll just pay the 19% as they have been doing. For next year, the year to 31st December 2023, they'll actually pay an effective rate of 23.5%. So that's calculated at 90 days up to the 31st of March at 19%, and then 275 days at 25%. Then the following year, as you can see on time, obviously you'll be paying the full 25%. So I think really a key action out of today's call is for everyone to just make sure you know what your effective tax rates are based on your year end and your circumstances, because this is vital to help you assess the benefits and disadvantages of actions you may be considering. And also you need to know so that you can accurately forecast for your business plan and for your cash flow forecast. So hopefully that's helped to give a bit of the background, give a bit of a flavour of how it will work, how it could impact your company. Now, Gerry was going to cover off on this question of incorporation. Is it still worth it?
Thanks, Jack, and good afternoon, everyone. So I guess right now, a few of you could be thinking, well, with the corporation tax rate increasing by a full 6%, should we be rethinking the whole limited company question? Should we be a limited company? Should we go back to being a partnership? Or if we're currently a partnership, should we be reconsidering whether or not to incorporate? And I think the simple answer to that question is that the basic advice is unchanged, in that there's a level once you start pushing into higher rate tax as partners of a partnership. There's a point at which, particularly if you are needing to retain a lot of those profits to grow, to reinvest in stock and working capital, that incorporation into a limited company is still going to be a good move. So the increase in corporation tax has changed the numbers, but it hasn't changed the basic formula, if you like. What it will mean is that the tipping point is slightly higher. So very roughly around £55,000 per partner is probably going to be the point at which the scales are starting to tip in favour of a limited company. At the point at which it starts to become really meaningful is probably going to be around £70,000 to £90,000 per partner, but that very much depends on various factors like how many partners you've got in the partnership and how you share your profits. So the next question is, if you are a partnership at the moment and you're thinking about incorporating, when is the best time to do that? And this is very much the £1 million question whenever you are looking at incorporation, but particularly right now with the rates about to change. And it does depend on a variety of factors, including things like when your partnership year end is and what your capital spend plans are for the next 12 months or so. So it's very much a case by case thing. And we always recommend that people sit down with their advisors and have a dedicated session going through the pros and cons of incorporation for you as a business, what the impact of it will be from a tax point of view, and in particular, what the best thing is to do on timing, because the timing can have a pretty significant impact, either in a positive way or in a negative way. So it's important to make sure you're properly, fully informed and equipped to make the right decision before you rush into anything. What then happens if you're a limited company and your profits are perhaps below the level of profits per shareholder that we've been talking about? Should you disincorporate? Should you go back to being a partnership again? Well, once again, this is very much a case by case thing. It may be a good idea, but there are some reasonably significant tax and practical implications in doing so. So I would certainly think very, very carefully before doing it. And often it's perhaps best to focus on, perhaps edging your profits up to the point where it makes sense to be a limited company, rather than necessarily having to go through the process of disincorporating. The other factor, I suppose, just to mention at this point, is if you are a business that's doing significant amount of trade with or in another country that perhaps has a lower corporation tax rate, and an obvious example of that would be Ireland, it may well be looking, there's perhaps an even more compelling case for looking at whether you can legitimately realize some of your profits in that jurisdiction. Now, this is a very complex area full of potential pitfalls. So what we would really emphasize is you don't rush into anything and doing anything without properly considering it and getting good advice on that point. I suppose the other factor to mention as well with company structures is there are things that you can do with companies that are not, that you can't do with a partnership or an LLP model, such as, for example, having a holding company to protect property and cash. So not all the decisions are tax related, I suppose, is what we're trying to say. So I hope that's given you some of our insights and thoughts on that. I'll hand you back to Jack now to talk about profit extraction and directors' remuneration.
That's good. Thanks, Gerry. It's useful to know. Now, another common question that we're seeing come out of these changes is whether the small salary and dividends route is still the best remuneration structure for directors, or should you switch back to a full salary through the payroll so that this then reduces your corporation tax payable? Now, I've spent some time working through the detailed calculations regarding this, and the important point to note is that the same strategy will likely not fit all shareholders, and the strategy that you've had up till now might not be the most tax efficient from 2023 onwards. Now, to help illustrate this and show what we're meaning, we've worked through and set out some remuneration structures and their associated tax implications to demonstrate this. Now, I should just point out, for simplicity, we're assuming that each director is taking a salary equal to their personal allowance. So our first example is a fairly typical example. We're looking at this over a 3-year period, and this director has taken £120,000 in dividends over that 3-year period. So from the company's perspective, they're paying out dividends £120,000. Because dividends are paid out of after-tax profits, there's no corporation tax deduction. So it's just costing the company £120,000. For the director, from their perspective, they're receiving the dividends and they will pay dividend tax on that. So they'll pay 8.75%, just over £10,000. So you can see there it's costing the company £120,000 over this 3-year period to provide the director with income of £109,500. So it's got a net tax cost of £10,500, which is low when you look at the amount of money that the director is getting.
The next example that we wanted to just show you was an example very much along the same lines, but introducing an element of interest on the director's loan accounts. So as most of you would be familiar with, most directors have a loan account balance in their limited company, and it's quite legitimate to charge a commercial rate of interest on that loan to the company. Now, the interesting thing about this is that most individuals have a band at which interest is tax-free, taxed at 0%. But conversely, the company gets a corporation tax deduction for the cost of that interest. So we've set out an example here again, £120,000 over 3 years, £5,000 of interest a year, and that's giving us a corporation tax deduction on the interest of 3,750 at 25%. So the net cost to the company is 116,250. Now, for the individual receiving this, there's no tax on the interest. The interest is tax-free, and they just pay tax on the £105,000 of dividends, 8.75 over those 3 years, and that's giving them a net in their pocket of 110, nearly 111,000. And the interesting thing about that is that having introduced what's a relatively modest amount of interest, the tax cost is almost halved down to just over 5,400. So that's just an interesting illustration of the effect of introducing even just quite a small amount of interest.
Then the third example looks at more of an alternative strategy to the dividends route, and that is charging license fees on intellectual property that you hold personally. So I'm thinking of trademarks or registered designs, so ones that are held personally in your own private names. So for comparability, obviously, we've said £120,000 license fee charged over the 3-year period. Now, the interesting point is that this is a tax deductible expense for the company. So suddenly the company is getting a £30,000 reduction in their corporation tax liability. For the director, they'll receive this income, but they will pay income tax at 20%. So they won't get the dividend tax, so it's a higher tax rate there. But what you'll notice is that it's costing the company £90,000 to provide the director with £96,000 income. So you've actually got a negative net tax cost. So you might say it's like a tax rebate generated.
So this is where it kind of starts to get interesting as far as pension contributions is concerned. If we think about, we've obviously talked before, and many will remember us talking about the idea of using pension funds to own commercial property, and that's still a good thing to do in the right circumstances. But we're looking at this through the lens of using pension contributions as a profit extraction or way of extracting profits and income out of the company over a slightly longer term, as a slightly longer term picture. So if we look at this illustration, you can see if we're putting in £120,000 of pension contributions from the company into your pension fund as a director, the company again gets a corporation tax deduction on that, 25%, £30,000 corporation tax saving. So it's only cost the company £90,000 in order to get £120,000 into your pension fund. Now, what happens when you come to draw that income out of the pension fund, how is that taxed? So the first 25% of your fund value is drawn out tax-free. So that's £30,000, zero tax. The remainder is taxed as you draw it out. Again, we're assuming over a 3-year period at 20%, being the basic income tax rate, £18,000 tax cost. Now, the interesting thing about that is if you think about that as an effective tax cost, that's a 15% effective tax cost, 25% tax-free, the rest at 20%. That's an effective rate of 15%. But the company's actually got a tax deduction of 25% on the way in. So you've got quite a big gap of 10% between the 15% you're paying and the 25% the company claims, which is then giving you a £12,000 tax rebate effectively. So it's only costing the company £90,000 to give you £102,000 in your pocket.
So then, as a final example, we want to just take that idea a bit further by combining this with the R&D tax relief that you can get, which many will be already aware of. But the key point is that pension contributions are included within a director's income when you're calculating that R&D tax relief. So we've got the same situation as before, but the only difference is that this director is spending 50% of their time on qualifying R&D activity. So you can see there that you've made the same £120,000 contributions, but your corporation tax deduction is not £30,000, it's nearly £50,000. For the director, it's exactly the same as Gerry's just gone over. They get the 25% tax-free, and then they pay income tax on the remainder. But by doing that, it's actually only cost the company £70,500 to give the director £102,000 of income. So I think it's just important to step back and point out the cost of having the wrong remuneration structure in place. So in this example, it's actually a tax cost of £42,000 over the 3-year period for that one director of having a wrong remuneration structure in place. I just want to point out that it's important that you make sure you get a rounded look at your specific situation, however, because you need to make sure all aspects of your income and your personal circumstances are taken into account for maximum tax efficiency. And we'd also recommend discussing any pension contributions with your pension provider so that they can advise you in relation to your circumstances and your allowances. And Gerry, do you want to cover off on what we should be doing now and what we should be looking to defer?
Thanks, Jack. So the next section, really, we just wanted to have a think about the corporation tax increase and the opportunities that there are from a timing perspective. So some things are best done now, some things are best deferred. And if we think about the fact that there's up to a 6% difference between the corporation tax rate this year versus next year, there's some opportunities to be had from a timing perspective which are worth thinking about. So firstly, what I just wanted to touch on was the subject of capital spend, capital equipment, and in particular, just touching on the super deduction. This is something we've obviously talked about before, and many of you would remember that. But just to do a quick recap on that, to understand what the super deduction is, what it does, and why it's relevant to be thinking about this now. So the super deduction was an allowance that was introduced for a short 2-year period. It gives a 130% first-year allowance, which is available on qualifying brand new plant and machinery, which is bought rather than leased by a company. So it's only available to companies between April 2021 and March 2023. And we can see here the effect of that was in effect to bring forward the 25% corporation tax relief on qualifying plant and equipment. So under the old rules, prior to the super deduction, if you spent £100,000 on qualifying equipment, you got a 19% corporation tax deduction, £19,000 of corporation tax saved. Under the super deduction, you spend £100,000, you deduct 130,000 against your profits, which gives you at 19% a 24,700 corporation tax saving. From next year, when the 25% corporation tax rate lands, you'll be spending £100,000, assuming the rules will remain the same, and that will give you a corporation tax saving as 25,000. So you can see that the tax saving under the super deduction versus the tax saving under the new rules is going to be quite similar. But there are some differences in that the super deduction is available. It's available on most plant machinery, which includes commercial vehicles, doesn't include cars. Also, it doesn't include what's known as integral features, which are basically fixtures like air conditioning, heating, lighting, plumbing, electrics, and it doesn't include hire fleet assets either. Those assets, with the exception of cars, however, will qualify for the annual investment allowance, which is 100% allowance rather than 130% allowance. Now, the question is, what should we be doing about that now? Or indeed, what should we be thinking about doing next year? Now, unfortunately, the Chancellor has thrown a bit of a spanner in the works by hinting in the spring statement that there was going to be some extension of either the super deduction or some equivalent beyond March 2023, but he hasn't told us what it's going to be. He's not going to tell us until the budget later in the year. So that's kind of great, but it doesn't make planning very easy. So I think the key takeaway that we've got here is that we know what the position is now, and we know that if we invest in super deduction qualifying assets now, we're in the same position as if we get a 25% corporation tax deduction next year when the rate goes up. So that gives us some certainty of knowing that we'll definitely get that corporation tax deduction. I guess the only downside of that is if the Chancellor comes up with something even better in the budget, then we've perhaps missed out on something that's even better. So the other alternative would be to wait and see what comes out of the budget in the autumn. And then you can, in a position to make an informed decision, either to buy now or to wait until next year when potentially it's even better. Which could well be the best strategy if you've got the luxury of time to wait. However, with supply chains as they are at the moment and lead times, that could be problematic. And it's worth just remembering that when you're buying capital assets, it's usually the date of delivery that's the important date. So if you're waiting till the autumn to buy something and then it doesn't get delivered until, say, May next year, then you could have lost out. So we would suggest, I think, that you think about what your capital spend plans are over the next 2 years, and think about when the best time is for that to fall. Are you best cracking on doing it now, or are you best leaving it? And that will very much depend on what your circumstances are, whether you can afford to wait, what assets you're buying. So that's a bit of an overview from the capital spend perspective. The other thing then is to think about where your profits are landing in this year. So moving away from capital spend, we're now thinking about realizing your profits. And if you think about it, you're better off. Normally what we say to people is what you're wanting to try and do is defer as much profit as you can, reduce your tax bill this year and push it into next year. This time, we're kind of saying the opposite, because you're better off overall, you're better off paying profits in this year at 19% versus next year at 25%. And the important point as well to think about, coming back to the timeline that Jack showed us earlier, is that the change for you comes at your next year end. It's not about April 2023 necessarily, unless you've got a March year end. It's your next year end that's important. So have a think about things that could be done to potentially speed up your profits legitimately, and realize them in this year at a lower corporation tax rate. And there's various potential options that could be considered on that. In terms of then the flip side to that is, if you've got the choice of deferring expenditure, you get a bigger corporation tax deduction next year. So you spend £100,000 next year, you get £25,000 back, versus this year it's only 19,000. So again, that's one to give some thought to. We've mentioned pension contributions already. That's a good example. Any pension contributions you make next year will give you a bigger tax deduction than they do this year. Another one would be charitable donations. Again, if you've got the ability to be able to wait and put those through next year, you'll get a bigger deduction on those. So give some thought to any expenses coming up that could be deferred. Obviously, we don't want to be deferring something that's going to harm your business's growth, but some things you've got the discretion to do that. So before we move on to the question and answer session, just some key takeaways for you to think about. The incorporation question is still very much a relevant one. The rates have changed, but the basic decision hasn't. So certainly consider that if you're still a partnership and you're starting to push into those higher tax rates. The holding company route is still worth considering, and potentially even more relevant with the new corporation tax rates, because there's some planning that could be done using holding companies. Finally, we're suggesting that businesses should have what we're calling a company tax plan, which is essentially looking at what your profit extraction plan is for each of the directors, making sure that you're optimizing the corporation tax deductions and benefits that are available, and in the sense of timing, like we've been talking about, and also a capital spend plan. So for clients that are we already do annual tax planning for, that's something that we'll be talking to you about shortly as part of your package. For anyone that isn't, and you feel that's something you could benefit from, certainly feel free to get in touch with us. I think our contact details are on the slide later, if it's something you'd be interested in exploring. Finally, just before we move on to the question and answer session, just to mention that our next event will be run on the 28th of June. And this is a two-part series, the first part of a two-part series on enterprise value. And this will be quite an interesting one. It's give you access to our insights into the latest market trends and data on business value, what's going on out there. And this is stuff that's not available online. You can't just find it on Google. And then there'll be a second part to the series where we really drill down into what that means for you and how you can use it to increase your business value. So over to you, Jack, to
Good. Yeah, thanks, Gerry.
Q&As.
Yeah, I've had some good questions come in. Go through these now. First one in relation to deferring charitable giving is, can I make a loan to the charity in this year and write it off next year for the charity's cash flow purposes? I think the short answer to that is no, because the company only gets tax relief on cash donations. So if it's not they won't get a tax relief on a loan write-off. We've had a number of questions in relation to the super deduction. Gerry, if you want to take this. Just combine a bit. So would the super deduction apply to, we've had warehouse racking and then also dust extraction equipment that could be removed?
So I think warehouse racking, certainly, because normally that's something that you'd kind of lift and take away with you if you move dust extraction equipment. I think it depends whether it's attached to the building or not. If it can be, If it's kind of standalone, I don't know what it looks like, but if it's on wheels or it's a unit that's perhaps just sits on the floor or whatever, then potentially.
That's good. Also had one in, I'm presuming it's a December year end, saying if profits for the first 3 months of the year are significantly higher than average, can you pay 19% on more than 3/12 of your annual profits? And again, the answer is no, because the tax rate is based on just the number of days. So 90 days at 19%, 275 days at 25%. So you can't vary it like that. You could look at running short periods, but I think my further commentary, but I think you need to be very careful, very sure of what you're doing, making sure there is actually a significant benefit. There's a lot more risk that you'll end up with higher profits in the later period at 25%. You say?
Yeah, so I think what the question's trying to say is, if we kind of split the year into two periods and realize as much profit as we can in the first bit at 19%, does that, is that a good way of going? And I think potentially, but you've got to be quite careful, because the year might not work out, things might not work out as you plan. So I would avoid trying to be too clever about that, if you like. There's a couple of other points, wasn't there, on the just looking on super deduction. One was whether super deduction claims can be submitted in retrospect, and I don't think there's any problem with that. That only relates to essentially last year and this year. So your last year corporation tax return, if it's been filed already, is still very much open to be amended if that's relevant. The other question I noticed, Jack, was just on whether you're better off doing the super deduction at nearly 25% this year rather than at 23.5% next year. And I think strictly speaking, that is correct, because if you've got a December year end, your effective rate for next year is 23.5%, not 25%. I don't think there's a huge amount in it, but if you're talking about very large amounts, it would certainly be worth thinking about. The other thing as well to be aware of is that the super deduction is actually uncapped, so you could spend as much as you wanted and still claim the super deduction if it qualifies. The alternative is the annual investment allowance, which is capped at £1 million at the moment, but it's actually dropping to, I think, 200,000 unless they change it from April next year. So I think probably a takeaway from this is use the super deduction while we've got it.
Yeah, it's good. We've had a couple of questions in relation to pensions. Firstly, is there a limit to how much money you can put in a pension in a year? The sort of simple answer is £40,000 per director. The only might say caveat to that is if you've got if you've made pension contributions in the past, you might have some carry forward allowances that you can also use. But I would check with your pension provider as to what carry forward allowances you've got available to use. And there's also a question: the pension drawdown, 25% tax free, can only be done once in someone's life. Is that right? Gerry, you take that one.
Yeah, that's correct. Yeah. So that's that would be realized at the point when you crystallize your fund. So I suppose what we're trying to illustrate is the lifetime tax effect of putting money into a pension to draw out. And if you look at it over the lifetime of a pension fund, as we illustrated earlier, it's incredibly tax efficient.
Yeah, that's good. Probably got time for a couple more questions. What interest percentage is typical on capital accounts? You may have further comments on this, Gerry, but I think the key thing is that it's a market rate for an unsecured loan. So you can't be charging interest at 20-25%. So look at what is a market rate in the current climate. Obviously, with interest rates rising, that will be increasing. but it's got to be market rate for an unsecured loan. And then we also had a question, please can you explain more about how the thresholds apply where are various associated companies and some make over 250k profits, some make sub 50k profits, and some might even make a loss. Now, I think the key thing is there's some fairly complex rules in relation to what is classed as an associated company. So you need to check that out and make sure, but in very broad brush, you might say the £250,000 limit and the 50,000 band are effectively split between the number of associated companies, but I would just make sure you're clear on what is classed as an associated company.
And if you've got a loss-making company that's in a group with other profit-making companies, you can always relieve one against the other.
Yeah, that's good. And then final question, any age limit to starting a pension and any time length before you can draw down once money is being put in? Do you want to take that on, Gerry?
So this is probably one for a bit of a one-on-one maybe, but there's no limit when you can start a pension fund. The limit is more when you can draw it down. So it's essentially a long-term savings plan, but particularly for those that are at the right kind of age, it makes a lot of sense to think about doing it. If you're younger, it might not necessarily be quite as attractive, but it's certainly, which really comes back, I think, to the point that Jack was making earlier, is that we're kind of moving away from a standard, what you might say, one size fits all approach to remuneration planning, more to a specifically looking at each director and saying, what's the best strategy for you?
Yeah, that's good. Good. That concludes our webinar. Thank everyone for attending. It's been good to have you on, and look for the link to register for the next event. Thank you very much.
Goodbye.